Okay, guys, so let's get the session kicked off properly. Definitely a bit of, well, risk-off tone, although Europe has been pretty resilient to it. If you look at my top two charts, then you're definitely seeing more downside appetite for US stocks than in Europe. We had a gap fill on the DAX, for example, opening lower and then actually bursting higher. But, you know, that's kind of downside for Europe being protected, if you like, by the expectations of Draghi's Christmas present he's going to deliver next week. But the main stories out of China really seems to have set the theme here. We'll talk about Black Friday and retail in a second, but certainly China's the focal point. The Chinese equity space getting hammered overnight, actually. A couple of reasons. Number one, some data. So industrial profits coming in, well, second worst reading of the year. Industrial profits down minus 4.6%. So yeah, second worst reading of the year, and just, you know, highlighting the fact that that growth risk that has been a real feature of 2015 has definitely not gone away. You know, things have calmed over the last couple of months. If you go back to August, of course, it was China risk that was dominating. But certainly in the last couple of months, things have, you know, that story's dropped off the front page, and investors have been reassured by a slight improvement in data, but perhaps more about the People's Bank of China, you know, willing to step in and do more. But this kind of data here just highlights the fact that actually that risk is still there. We still should be worried about it. And when you get data points like the one this morning, then, you know, just brings that risk back into the headlights. But the other story is perhaps probably a little bit more. It's probably the bigger reason as to why equities got hammered so much. It's quite incredible, really. But so China's biggest brokerage, a company called CITIC Securities. Really, it's unbelievable. But they've admitted they overstated their derivative business by $166 billion. That's how much they overstated it by. And the reason, so they're talking about their equity swap transaction volume, basically. And the reason, they're blaming it on a system upgrade. A system upgrade meant that they communicated their business was $166 billion more than it actually was. Quite extraordinary. But anyway, obviously they're the biggest brokerage firm, and obviously, you know, the big story of the year, of course, has been the Chinese equity space. It's been the brokerages that have been, you know, seeing a ridiculous amount of volume increase, margin lending, and brokerage transactions fueling that meteoric rise for Chinese equities. For the first half of the year, Chinese equities up about, well, really 100%, basically. Of course, it all came collapsing back down. So yeah, of course, it's directly affected CITIC, but, you know, the brokerage space across the spectrum getting hammered last night on the back, I should say this morning, on the back of this story. It's fed through into Europe. So these two things, it's definitely fed through into the European session. We definitely got a bit of risk off at the open. Things that, as I said, Europe has kind of stabilized quite nicely for now, at least. A couple of things like, well, if you just looked at the DAX chart, for example, we opened quite a bit lower, down at 11,250. Pivot doing a good job, but then as resistance, but at 8.15 we just popped higher and closed the gap. Nice gap fill, trading back up to yesterday's close. You know, we kind of just I'd probably still favour the downside here. This breakout higher hasn't lasted long. We've closed that gap, and I think perhaps the US markets are showing the way here in the downside bias is probably going to be the feature of the morning, if not the day. We'll have to wait and see, of course. But certainly a bit of lively action this morning because of China. Bund opened higher. That had a nice clean gap fill as well on the way back, finding support at the pivot level. Now back to pretty much where it was at the open. So interesting start because of China. Now let's talk retail. So it's Black Friday, of course, day after Thanksgiving, and the most important retail day of the year, of course, for the US retailers. Why is it called Black Friday? A bit of irrelevant information for you. There's a bit of uncertainty as to why, but basically the main thought is that it's called Black Friday because it's the day in the year where retailers move into the black. It means they're, basically from this point on, what they make from this point into year end is profit. They spent almost 11 months of the year making enough money to cover costs, and now from here onwards it's upside. So they move into the black. Of course, actually these days, firstly, it's not actually just today, i.e. the day after Thanksgiving, it's the big retail event. It actually started yesterday. So a lot of stores were opening at like 6 p.m. in the US yesterday with huge deals. Like Gap opened at 6 p.m. with 50% off everything. Then they're open obviously today with another 10% off the 50%. So massive sales across the board. There's a stampede of shoppers flocking to every store you can possibly imagine. So it's a big event, and what it is it's an important measure for the strength of the consumer. It really kicks off the shopping season that kind of extends right the way through till Christmas. So just looking at this, it's a couple of charts here, and one of the FT articles is covering this kind of story, and they're looking at how, quite interesting, if you're looking at the S&P 500 retail space, look at the top chart. That's actually the department stores in the S&P 500. There's actually only 3 of them. So this sub-index actually is only made up of 3 companies, Nordstrom, Macy's, and Kohl's. So these lot have been significantly underperforming the market over the last sort of 4 months, down 16.3%. Down 30% year to date. But they issued profit warnings a few weeks back, and as meant, at the start of November they issued a profit warning, and a lot of these retailers actually began their promotional sales at the start of November. And that's kind of been a feature, I guess, of the last few years. You're seeing the sales begin early, and that's because retailers are struggling. You've actually seen the last 2 years, Thanksgiving has shown declining sales year on year. So what we want to see this year is that pattern of declining year on year sales to be reversed. It's important. I think we need a retail weekend here that delivers more dollars spent than last year. If we have 3 declining years in a row, then that just indicates that the strength of the US economy perhaps isn't going to be resilient enough to deal with things like Fed interest rate hikes. But it is just the department stores, because if you flick down to some of these other charts, so on the left here I've got the retail index. So this is actually all the shops. There's obviously loads of companies in this index, and they've had a pretty good performance. And it kind of reflects the perhaps changing behavior of the consumer. Department stores are suffering. They're struggling to deal with how consumer behavior has shifted. Obviously, online retail's an ever-growing story, and that's not going to stop. So at the expense of department stores. So you've got a pretty notable divergence with department stores getting hammered here, whereas actually the retail sub-index has been nice and strong. Consumer discretionary, really strong. It's been a real bright spot. If you think about the index being pretty much flat on the year, actually it's probably, let me see that. Because we're trading 2,086. Let me put this on a yearly chart. Let's have a look. So yeah, we're up on the year. The opening price of the year for the S&P 500 was 2,055. So we're 1.63% up on the year. But actually, the consumer discretionaries sub-index of this S&P 500 is up 16.4%. So you've had a pretty notable outperformance from all the retail space apart from department stores, which have gone the opposite way. So it's these department stores that are desperate for a good weekend here. So Black Friday today, it's actually something called Cyber Monday next week. And this is where everybody gets back to work after a 4-day weekend of boozing and shopping and doing whatever. And then apparently everyone gets back to work, or the idea is everyone gets back to work. They're depressed, they're sat at their desk, and so they need a bit of retail therapy to cheer them up. It is officially the biggest online retail day of the year in the US. This is, of course, it's no longer the biggest retail day of the year globally. China have stolen that. November the 11th, Singles Day, where Alibaba clocked in $15 billion of sales in one day. So that's definitely now the big retail day of the year globally. So Thanksgiving's been knocked off. But actually, 5 years, I was just thinking about the UK and how the marketing men kind of export this stuff. Apparently this year, today, apparently, I can't believe this is true, but we'll see. Apparently today is going to be the biggest the retail day of the year in the UK, apparently. 5 years ago, it didn't exist. We didn't have Black Friday here, but now it's kind of everywhere. And I can guarantee you, I bet you, in 5 years' time, Singles Day will be a global phenomenon. It will no longer be confined to just China. I guarantee you the marketing men are going to be all over it, and it'll become a global event. So anyway, this is what's going on. Now, from a market's point of view, don't get your hopes up. Well, I think this morning might be active. We've had a pretty interesting start with the Chinese, that's for certain. I think that's a bonus. I think as we get towards the US part of the day, then you're going to see conditions really drop off again. Most people take a 4-day holiday here. I'm showing you on the volume front. If you check out the volume for yesterday, well, actually, look at that. We've already had more volume today than we had yesterday for S&P 500 futures. You can obviously see that it's the lowest volume day of the year. Obviously, the cash markets were closed. Cash markets are open again today, but it is a half day. What does that mean? Well, it does mean that volume's going to be very, very low, higher than yesterday, but still, it will be pretty much non-existent. So do bear in mind, most of the action today will be this morning. Let's have a quick look at the calendar. There isn't that much data either. There's certainly no data this afternoon, so it's all this morning. The data we've got, some figures out of the UK at 9:30, looking at the second reading for Q3 GDP. We're expecting it to be unchanged as it was announced a few weeks back, plus 0.5% quarter on quarter, 2.3% year on year. We get some exports and imports numbers as well. Just in a few minutes, we're going to get consumer confidence from Italy, and business and economic sentiment numbers. These aren't going to move anything. I think the UK numbers, well, they'll probably be in line. It is the second reading. Of course, cable will be sensitive to that if the data is different, but it's probably not going to be. And then at 10 o'clock, we have economic confidence figures from Europe. So, of course, we'll cover that. We've got some ECB comments from Not, who's hawkish, due at 12 o'clock. We have a few auctions down here. We've got an Italian 10-year, 5, 10, and 7-year auction. They auctioned some T-bills yesterday without any problems, negative yields, of course. UK auctioning off some 1, 3, and 6-month T-bills this morning as well. But as you can see, markets close early today in the US. So we will get another low volume session. Let's just check in on oil. Today is it's like the warm-up meeting for next week. This is where OPEC will meet in Vienna. This is the venue for all their meetings. And today we're getting the meeting of I can't remember what they're called now, the economic advisors or something along those lines. But it's basically the kind of pre-meeting ahead of next week's official meeting where all the OPEC oil ministers get together and they'll decide what they want to do. But what we've seen with crude's had a pretty good week. Thanks to that Saudi comment at the start of the week that created a bit of volatility. We are up on the week, although we've drifted lower overnight. We've been down below yesterday's low this morning. You can see just a bit of a lift off $42 here, trying to get back up towards S1. But generally, it's been a solid week. So we'll just be aware there might be some comments, oil-related OPEC comments from Vienna as we go through the session. But of course, the official meeting's not till next week. Right, let's get on with it then. Just keep things tight. On days like this, where volume's going to be light, it's far easier to it's far easier to do a lot of damage today than it is to actually make a lot of profit. So I keep your expectations modest and keep your patience levels high. Be my advice. Okay, let's get on with it. Enjoy the day.